So part of what I think about with this session is when somebody presents you with an office investment. So you see a broker's offering memorandum that has an office asset for sale. And all an offering memorandum is the marketing document that brokers use to project the asset to the market to try to determine and try to assess who's interested in buying the real estate. And office is a very unique asset class and property type, in my opinion, because I think it's one of the most expensive property types to own and maintain. So if you think about office assets, especially office assets in major markets, think about New York City. These are assets in very dense locations, so getting to them can be challenging from a work perspective. I'm always thinking about the office assets from the context of if I need to put a roof on, if I need to replace the elevators, if I need to do anything to the exterior of the asset. So thinking about the fact that office assets, if you're in major markets, can be expensive to get to from a physical perspective if you're getting work done. Think about the fact that if you need to replace the roof and you've got a 60-story office building, just getting there is expensive, right? So the office asset is expensive. Other areas with which it is expensive is when you do leasing at an office asset. You're paying a significant tenant improvement allowance, which again, a tenant improvement allowance is the money the landlord conveys to the tenant to create the office environment that they're looking for. You're paying a leasing broker to bring a tenant to your building, right? So office, my very first instinct when I see office and I think about office is expensive. So that's the first instinct that I have when I think about this. Then related to that is, well, how old is the building? Because if we're talking about a building that was recently built, I feel much better about our long-term exposure to all these costs that I identified because all the physical elements of the building are relatively new. If you talk to me about an office asset that's 20 years old, 25 years old, I get very concerned because a lot of the major capital items, physical items within the building have an age of 15 to 25 years. So at that point in time in the gestation of the building where a lot of stuff's frankly just going to wear out and it gets very expensive. So when I think about office, my very first thoughts are how old is the building and trying to get some sense for how well it's been maintained. Now, the owner of the building will have a huge impact on the overall condition of the asset. So typically institutional owners maintain assets very well. So if something needs fixed, they replace it. If something is nearing the end of its useful life, it's replaced. Private owners might try to extend the useful life of some of these physical items and might delay the replacement of some of these aspects. So when you're buying buildings, understanding who the seller is and the profile of the seller might help you think about what your level of exposure is from the real estate perspective. So again, just to begin with, I start thinking about the age and the costs associated with it. The other thing that I think about a lot when it comes to office assets is what is the historical occupancy of the building? This pertains principally to assets that have some level of history to them, meaning if the building was built 2 years ago, knowing that the historical occupancy of the building is 95% really doesn't help me that much. But if we are buying assets or looking at buying office assets that have a significant amount of history, meaning they've been in existence for a period of time, I have found that the historical occupancy metric that you can get is very helpful in identifying how attractive the building has been on average to the marketplace. So if on average the building has been 95% leased, and it's been in existence for 20 years, that would suggest that the building has a pretty good history of being able to remain full, which would suggest that during your ownership period, a similar outcome could be reasonably expected. If you're looking at a building that has a historical occupancy of 75%, and your strategy with the building is to invest capital and move it to 90%, that could be a challenging execution at the asset. So I look for the historical occupancy early on and when I'm doing my diligence in the property. I think that metric is indicative of the success you're likely to see with the investment. I also obviously look to the rent roll, right? So the things I think about as it relates to the rent roll, is, number one, what is the weighted average remaining lease term at the building? What that simply means is if I take all of the individual leases and the square footage of each individual lease, and I compare that to the remaining term of the lease, so how many months are remaining for each and every one of these leases, and I weight it by the size of the lease. So the larger the larger leases have a greater influence on the total weighted average remaining lease term. To understand, is this property presenting me a situation where I am having to do a significant amount of leasing early in my ownership period? Or is this an asset such that I won't really have to address any of the leasing until far later in my ownership period? Because that is an indication of risk. So again, if I have a weighted average remaining lease term of 18 months, that means on average all the leases in the building are going to expire within 18 months. That means I'm going to have to do a lot of leasing in the property in a very short period of time. If the weighted average remaining lease term is 8.5 years, that means on average the in-place tenants will be at the building for 8.5 years. So that suggests that I have a pretty good runway in front of me in terms of the existing tenancy. So I look at the rent roll, I look at the weighting average remaining lease term. I also obviously look at the credit. The credit of a tenant is simply what is their financial stability. So if somebody is if a tenant is called a credit tenant, that means they have a sufficient financial wherewithal to pay their rent. So making things up, you could consider Starbucks as an example, a credit tenant. Having a Starbucks in a building would be attractive because they're a strong company financially, and there's a high likelihood that they're going to be able to pay their rent. If you have a bunch of non-credit worthy tenants in the building, you may be exposing yourself to things like credit loss, also known as bad debt, where you have tenants that are failing. So I look at the rent roll, I look at the weighted average remaining lease term, and I look at the creditworthiness of the tenants. I next consider the relationship between the in-place rent and the market rent. So the in-place rent is the rent that the tenants are contractually obligated to pay right now per the lease. And I compare that to what the market rate would be if I had that space available to me today. So that's relevant in a couple different ways. So if I have an in-place rent of $25, but the market rental rate is $35, I would actually hope to buy a building that has shorter remaining leases in place because my objective is to roll as many of those tenants up to the $35 rent as I possibly can, as quick as I can. So if you have a weighted average remaining lease term of 18 months on a building that has an in-place rent of $25 and a market rent of $35, that's an attractive opportunity for you because you have short-term leases that are below market. The opposite, though, is if you have in-place leases that are dramatically above market, you will then have a circumstance in almost all instances where the rent is going to roll down, as they say, to market. So if it's the inverse, that in-place rents are $35 per square foot and the market's $25, and you have 18 months of weighted average remaining lease term, you can be pretty sure that those in-place rents of $35 are going to be something closer to $25, assuming those tenants renew. If you bring in brand new tenants, they're probably going to be paying around $25 because that's what we're saying is market. So I think a lot about the relationship between in-place rent and market. I think a lot about termination options. A termination option is the tenant's unilateral ability to terminate the lease at their discretion. And as a landlord of a property, as the owner of an office asset, I worry about termination options because that is outside of my control. So if I have a significant tenant that has a termination option, they could unilaterally trigger the termination option and exit the lease with no penalty, exit the building with no penalty. I then have a vacancy within the building that I need to release. So as a result, I would look at all of the leases at the property of significance. If you have a small tenant that's 500 square feet that's a fraction of a percent of the revenue of the property, I'm probably not terribly worried about it. But if I have a tenant in the building that represents 25% of the revenue stream at the property, I'm probably worried about the fact that they have a termination option. And you could look at that in the sense of, if they have a termination option and their in-place rent is higher than market, you would expect that a tenant would come to you if they have a termination option and they're paying above market rent to say, look, can we renegotiate the lease? Because otherwise I'm going to trigger the termination option, which allows me to exit the lease because I'm paying meaningfully more than what I would be paying in any other building, or even in this building if we were to renew the lease. When considering office product, I also think about, is it suburban or is it urban? And that has a meaningful impact on the way I think about the asset. So let's take suburban for a moment. For the most part, suburban office product is what we would call commodity product. And commodity product means that it's not that dissimilar from any other office assets in that general location. So if it's a suburban asset and it's a commodity product, you're most likely competing on price alone when it comes to rent. So if you're trying to rent the property, the rental rate that you're charging may be the single most important factor determining whether or not you lease the space or not, because the tenant believes that your office building is not that terribly different from the one across the street. That puts you in a challenging position as the owner because you're only competing effectively on rent as opposed to amenities at the property. Now, urban assets are far more attractive from the standpoint of, and far less commodity, because they have a variety of amenities both within the property as well as in the surrounding areas. So from a risk perspective, suburban always feels more risky to me than urban because of the commodity nature of the asset. Now, the qualifier to that is there are exceptions to every rule. The final thing that I think about amongst these early initial thoughts is, where are we in the cycle? So if we believe that we are in a trough of a cycle and we have short-term weighted average remaining leases, that might be a particularly interesting acquisition for me, because we have leases that will soon be expiring and we will be able to release the building at hopefully rental rates that are indicative of an improving local market, meaning we're in the trough of the real estate cycle currently and we will only improve, meaning that we should begin to see rent growth as we proceed through the cycle. So you may be more interested in owning an office asset of that profile at the bottom of the cycle. The other is if you believe you're at the top of the cycle, right? If you're at the top of the cycle and you have your same weighted average remaining lease terms of 18 months, you might not be terribly excited about that asset because you could be having to release that space as you run down the cycle and at rents that are below what they're paying right now. Conversely, if we're at the top of the cycle and you are looking at a newer office building with a 8.5-year weighted average remaining lease term, that might be an office asset that you might contemplate buying because you have 8.5 years of remaining lease term. So even if the market were to degrade and go down from a rental rate perspective, you have contractually obligated leases at higher rents.